Hello, chart watchers, and welcome to this Wednesday, June 27th Market Watchers Live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. So far in the market today, the Dow Jones Industrial Average up 149 points, but it is down off of the earlier high. It filled the gap from a few days ago and is starting to retreat back. The S&P 500 doing the same up into its gap resistance zone and then pulling back, but it is still up 12 points today. The NASDAQ on a relative basis not performing as well, only up 7 points as it continues to struggle beneath its 20-day moving average. The Russell 2000 on a relative basis performing the worst today, actually down almost 6 points so far on the session. 10-year Treasury yield continuing to move lower, down about 3.6 basis points today, 2.84%. Volatility down about 1% today, which is maybe a little bit because of all of the strength that we saw at the open, but still elevated relative to where we were last week. Energy continues to perform well. Crude oil has moved back up above $70 a barrel, and that is lifting many of the energy shares. Materials and industrials both getting a bounce. These were two areas hit hard on trade talks recently, but they are bouncing, although still technically challenged. Consumer staples continues to be one of the best performing areas of the market in the near term. It's been uptrending throughout June, throughout all the trouble and the fear. Consumer staples actually bouncing nicely, up another 25 cents today. In the news today, Conagra Brands announced that they would be acquiring Pinnacle Foods for both cash and stock, totaling about $8.1 billion. Earlier this morning, they were both higher. Well, at least Pinnacle Foods was higher, but you can see both have turned lower. And at this point, we've got Conagra Brands down 7.38%, while Pinnacle Foods is down by about 4%. Want to mention also, it is June 27th, so we're only, my gosh, it's only about 6 weeks away, something like that now. Just want to mention ChartCon. Don't forget, make sure you sign up for ChartCon coming up in just about 6 weeks. Going to be a great conference. And Erin, it's middle of the week, hump day, the market, trying to recover a little bit of the losses from earlier in the week, but still, I don't know, seeming kind of weak to me right now.
Yeah, I think so. I had gone over the, my climactic indicators and it definitely looked like a selling exhaustion. And we're starting to see a little bit of a bounce off that. I don't know. I'm thinking like you. I mean, it is rather weak. This could just be that bounce after some really difficult decline, but I'm afraid we might have to look at a little bit more decline before we move forward.
Yeah, and the selling that's taken place here over the last couple of days, the NASDAQ and Russell 2000, as a shorter-term trader, that concerns me because that is the more volatile issues. These are the names many traders are out there looking at, and as they continue to underperform and struggle to get back up above key levels, I think that could result in some more selling, at least in the near term. But we'll see. Got a lot to check out before the day's out. Also want to mention that we've got Scott Carney here with us. Welcome back to Market Watchers Live. Scott, how are you doing?
Oh, I'm great.
Oh, there we go. Okay. Everything good?
Excellent. Thanks. Yep. How you guys doing today?
Yeah, not too bad. I know when we had you on, it's been a couple months, hasn't it? 2 or 3 months?
I think back end of January, before the big drop. Right before that big drop, we got into it. We introduced that XABC pattern tool that's now on StockCharts, and it's been quite a year so far.
Yeah, I was going to say, I was thinking maybe we had talked to you after all that volatility hit, but certainly be interesting to hear your latest, given all of the volatility that we've had to weather here in the first half of 2018. And I don't know if you're planning to give any kind of forecast to what you see for the balance of 2018, but it seems week to week like things are changing here in the market.
It's definitely different than last year's straight up move, and I don't know if anyone really anticipated, maybe a pullback, but not certainly the degree that we saw that started right at the end of January. So it's been really interesting. Yeah, I've got a few things to share with you guys.
Cool. Yeah, I know it was back at the beginning of the year. I don't know if you remember, Erin, but we had a poll, and one of the questions, I think it was toward the end of January, we were asking if would the Dow Jones hit 30,000 this year or something like that. It seemed like a foregone conclusion at the time, but doesn't look so much like it at this point.
Yep, I have to go check what I told Timer Digest as far as where I thought the Dow would be at the 6-month point. I don't remember. I'm going to have to go check it out, see how far off I am.
Absolutely. Well, I'm sure I was pretty far off because I was pretty bullish to start the year. Although I'm still pretty bullish after the sideways consolidation, but that's another story. Scott, hang in there with us, though, because we're going to have you back in here in about 10, 15 minutes or so, and we'll let you get through that presentation, see where you stand with the market.
All right, great.
All right, Erin, I'm going to let you take it away for the schedule agenda, and we'll get this party started.
Yes. Dan Russo from Chaikin Analytics is going to be here with us tomorrow. Looking forward to talking to him. Always a high energy guest. Everything stock charts. And from what I've been able to see, Chip Anderson's going to be coming in for that. And we'll have July seasonality. Tom, you're going to tell everybody what to expect for next month based on historic tendencies. Decision point review. I'll do the monthly chart review the following Monday. And on July 4th, I believe is I have my workshop. I'm trying to skip over my workshop. I'll be doing a workshop. Don't know exactly what I'm going to do it on just yet, but I'm thinking about a revisit to chart patterns. So if you want to let me know in that survey what you would like me to do. And then, of course, we have a day off on July 4th. So there won't be a Market Watchers Live. Not much to talk about in the market if it's not open. Today's agenda, let's look at it. As we just introduced, Scott Carney's here. He's going to show you how to use that XABC tool. And 10 and 10 to 1, our first symbol is going to be R1 RCM Inc. And that's RCM is the symbol. And finally, we're going to finish with a new segment called Trade-Off. And we'll talk to you more about that when we get closer. Okay, Tom, technical news, headlines. Do we have any economic reports today?
We did, and they weren't great. May durable goods came in. That actually matched expectations, a drop of 0.6%. But if we strip out the transports, there was a decline of 0.3%. The market was actually expecting a rise of 0.5%. So a pretty big miss on the durable goods ex transports. Although I will say that durable goods do tend to be somewhat volatile. And so I'm not shocked by it. And I think from the action that we're seeing in the market, I don't think the market's paying a whole lot of attention to it. May wholesale inventories also came in a little higher than expected, 0.5%. Market only looking for a rise of 0.3%. And then finally at 10 a.m. Eastern, May pending home sales came in much worse than expected. They actually dropped 0.5%. The market looking for a rise of 0.6%. And a result of all that, well, we've got the 10-year Treasury yield moving lower here by, looks like 3.6 basis points right now. So it's down at the 2.84% level. We did have a big gap up that occurred from about 282. We could be going back down to fill that gap. Of course, we have a couple of recent lows, one in May about 2.76%, the other beginning of April back at 2.72 or so. But still, this is kind of a little unnerving because as money is rotating into treasuries, that's what's sending the yield lower. So as treasury prices move higher, yields move down, and moving into treasuries is a signal of money rotating into defensive areas of the market. And I mentioned at the top of the show, when we look at the XLP, this has been one of the best, if not the best. I think this, along with utilities, during June, you can see we've been strengthening, looks pretty good. Now, the overall longer-term downtrend remains in play, but at least in the short term, consumer staples have certainly turned higher, and I think that is bullish, at least for that defensive sector in the near term. XLU is the other one I mentioned, and you can see the huge move up here. After an initial drop in June, we have rallied back very strongly in the utilities, breaking out above these prior highs. And one of the ratios that I like to follow has really fallen apart here recently, and I expect that it's going to turn back up again. But if we go out, I'm going to look at a longer-term weekly chart, and let's set up a line chart. It's the only time I really like to use line charts is on these relative ratios. Just it gets rid of a lot of the noise. But here you can see, look at the decline that we've seen on the transports versus the utilities here in the month of June. So as the utilities have been rising, transport's been weakening, and this ratio has been going down. You can see that since the summer of 2016, we have been pretty much on a course higher. Obviously, we've had some volatility in the midst, but overall, we're continuing to put in higher highs and higher lows. And so I'm watching these recent lows here on this ratio to see whether or not this holds at about 14.70. Failure to do so, I think, would start to suggest a little bit more weakness under the surface of the market, which would not be good. Now, as we consolidate, you can see all of this weakness in this ratio has occurred since the market topped back in January. What I'd be most concerned about would be the market breaking out to new highs while this ratio begins to fall apart, because that would suggest that defensive stocks are beginning to lead the market to the upside, and that can be the very final stages of a bull market. So that would be something to keep in mind. But still, it's unnerving if we move to a multi-month low in this ratio. Let's take a look at a couple of the major indices here. First, the Dow Jones. Of course, the Dow Jones was really beaten up with a lot of the trade talk, trade fears, the rising dollar, all of those different things. But the past couple of weeks, you can see we dropped from about 26.4 all the way down almost 24,000. So that's, or excuse me, that was 25.4, not 26.4. 25.4 down to about 24,000. So roughly about 5%. And that's a pretty steep drop on the Dow over just a couple of weeks. We're bouncing, but you can see we are still below both the key moving averages, the 20 and the 50-day. And as we move up, it looks like we might just be moving up to test this overhead resistance that's created from the breakdown we saw just 2 days ago. So I'm not sure I'm liking exactly what's going on here in the Dow. Let's move on to a monthly chart, and you'll see that the 50-hour SMA is creating some issues here in the near term. I'm going to go back a few months here. I'm going to go over the major indices on the hourly chart today. But here you can see the downtrend that's been in play. We did struggle at that 20-hour moving average. We did finally break above that and get up to the 50, but it looks like we might be rolling over again. And this rolling over looks more distinctive on the NASDAQ and the Russell 2000. We'll get to those in just a second. But first, let's pull up the S&P on this 3-month hourly. The overall trend still appears to be higher as long as we hold the late May low, which is down around that 2675, 2680 area. We did make it back up to about 2746 earlier. We've got some overhead resistance. I'm going to say in my blog this morning, I was kind of using the range from about 2690, which is this gap support here, up to about 2740 as a short-term trading range. We did get through 2740. We've pulled back, trying to hold what is now a rising 20-hour EMA. You can see that we tried to break above it just at the latter part of last week, and the 20-hour was starting to turn up, and then we fell again. Here, we've actually broken above that 20-hour, pulling back. I think it's going to be important to see whether or not we can hold that in the very short term. I don't think we will, and the reason is we've already seen the NASDAQ and the Russell 2000 go up and test that 20-hour moving average, and they're both starting to roll back over. Here you can see the NASDAQ. I think, again, a couple of key levels to watch on the NASDAQ, if I annotated here, would be this breakout level. Also, there's a gap support zone from late May right here where we gapped up to start June, and we haven't gone back and tested that area until the weakness we saw earlier this week. So I think we're going to head back down. Now, I'll be surprised if we don't make another move back down to perhaps move into that 74.50 to 74.75 area. And we'll see what the market is made of, especially what the NASDAQ is made of when we get there. Now, if we do move back down to a new low, I think what we could see is a nice positive divergence form on this hourly chart. So that's something to keep in mind as we move forward. Finally, let's take a look at the Russell 2000. I think you're going to see a very similar chart. The Russell 2000, which had been leading the larger cap indices, both the Dow and the S&P 500 throughout April and May and into June, has suddenly begun to underperform. And you can see that that falling 20-hour EMA is becoming an issue here for the Russell 2000. But again, if we break to a new low, if we take out the lows from earlier this week, we could see a positive divergence begin to form. All right, we've got a couple of upgrades and downgrades, so I am going to let Erin take it away and go over those with you.
All right, let's take a look. All righty. We did have 3 upgrades we'll look at and 1 downgrade. So I'm going to go ahead and just start right there with the downgrade that we have. Obviously, the stock and traders were taken aback and definitely following through on this downgrade. You know, we are getting ready to hit some important support. But honestly, when you see a scooter falling out of the sky, that means, relatively speaking, you know, GMED is doing worse than most. And you know, with a PMO that is in decline like we're seeing as well, you know, the momentum is obviously, it was already going the wrong way, and now it's accelerating downward. So I don't see this as an excellent opportunity for bottom feeding, if that's where you wanted to go with this. Personally, with my trading style, I'd stay away from it. But I think you could certainly put on a watch list if you are, you know, a shorter term trader, maybe okay with taking some risk. I could see getting in and setting your stop here at this support level with the hopes that it'll come back up to this 52.50 level. But I think that one's a dangerous play. GE got upgraded today. And, you know, I'm sure all of this happened because, you know, I got out of GE and now it's starting to get higher than where I had bought it back in May. So I'm kind of wishing I hadn't done that. But, you know, I'm not so sure the upside potential here. You know, we're getting, GE's been in the news a lot, you know, obviously leaving the Dow, which Tom and I joked obviously was, you know, really good for it. So who knew? But you can see we did finally climb above some overhead resistance here at $14. And, you know, the upside potential is certainly right up here at that like 1550 level. I've got the PMO buy signal now coming in. You can see the scooter is starting to come alive. I would just be really careful with GE. That seems to be really flapping around in the wind based on news. I don't personally like that kind of volatility, but this might be a good play to get into. Put it on the watch list, maybe see if it'll pull back a little closer to that $14 range now that it had this big breakout. Let's see, Marvell Technology Group also upgraded today. And we can see on the upgrade, if you look over here in the thumbnail, we have a gap up as well as a pretty good move on to the upside. We're looking at over 3.5% higher. And, you know, we got above that 200-day EMA, but right now we're trading below it. The PMO is starting to decelerate, but I just don't see enough good information here. I just don't see enough, you know, it just doesn't look healthy enough. The upgrade, giving it that big boost, I would be a little bit concerned about the backing off. I don't see a really good reward to risk set up here as far as stops. So personally, I would stay away from it. Maybe if we could get it to trade consistently above that 200-day EMA, I might reconsider. And finally, OKTA. I thought this one looked rather interesting, but again, you know, we've got PMOs in decline. On the upgrade, we're not seeing that much in the way of deceleration. You know, we've got a nice 1% move to the upside. However, with this one, you know, with the upgrade, and it's trading very near the support level we saw earlier last week, actually earlier this week on Monday. So I actually am liking this as a possible play because you could set that stop fairly tight below that 50-day EMA, possibly at that $48 level. And then the upside potential, I think, is pretty good here. So, you know, I like this one. So I think on the upgrade, this one could have some good upside potential. But I didn't mark it, but I can see a little bit of overhead resistance sitting here. It traded above, but again, it pulled back. So keep an eye on this one. I think this could be an interesting play. And that's all I had for upgrades and downgrades. I think it's time to bring in our special guest.
Absolutely. Scott Carney, welcome to the show. Welcome back. And what do you got for us today?
Thanks, guys. I want to get right into really looking at a couple of the charts on the Dow Diamonds and some daily formations, really since the last time we spoke. That incorporates that XABCD tool and show a few of the harmonic patterns that have really defined the current action. Seems like it's been pretty chaotic, but let me jump in here for a second and show this.
I think chaotic's a good choice of words. It's been
Yes.
a lot of headline news. There's been a lot of volatility. The VIX really spiked back at the beginning of the year. And this year has certainly been unlike what we saw in 2017, where we barely had a pullback. So it's going to be, interesting to hear how you're adjusting to everything that's going on around you in the market.
Yeah, let me start. I'm going to jump right into the charts, and I'll go back to some of the stuff that explains it. But I really want to just kind of focus on what's happened. And this is the last about 8 months or so, 7 months of the diamonds action. And after we literally, I put my cursor on where I think we met around the 20th or 25th, right here, right before that big drop in all the markets. And but despite that drop, I think the real opportunity has developed over the last few months. And I think this kind of action, this consolidation action, is exactly where M and W patterns really can be helpful for traders. And so what this is, and what this M formation ended up resulting in after the consolidation from the February low to the April retest, was this M formation that basically put what I would call harmonic support for the diamonds at the 237, 236 level. And that's measuring it because of this specific alignment. And this is a really nice Gartley pattern. Gartley pattern's pretty well known in the community, but the specific measurements that make it a Gartley are certainly here, that say, hey, this is something we want to pay attention to. This has, and it has been erratic, but the way we look at harmonic patterns, some of the interpretations that I've introduced with how to handle, say, the initial reaction versus a secondary retest, really does matter. And it kind of helps us to outline, how to understand what the pattern means, the retest means. And we look at this usually as an initial move, which we got up to this 618 target. And that's what most patterns actually provide, is a secondary retest. And so we come back to 237, 236 level, and now we've have a larger move. But okay, so now what? Now that bullish pattern has turned into a bearish pattern that we need to consider. And this is all within a larger consolidation zone, and it's squeezing definitely where on the top side resistance, this bearish pattern, we see a pretty strong reaction. But like I said, going back to the initial example, this is the first reaction. And so I think you alluded to maybe being a little bit overdone on the downside. And that's why we might be seeing at least some recovery today in the last 2 days. And that's also because we've reached our primary objective from just the harmonic pattern framework, the way that this has played out. Now, I'm going to say that, again, this would only be a valid analysis as long as we have this M and W formation. And again, we see another M formation where for the Gartley pattern, it has to be at that 618, that golden ratio. Some of you might know about that. It's a really interesting subject. I encourage everyone to search about Fibonacci and the 618. But for our rules, and just to keep it simple here, this structure adheres to yet another Gartley pattern. So we've gone from one Gartley, a bullish, to a bearish. We've reached that initial target. And certainly this actually reinforces where for the Dow diamonds on the top side, that 251 level is what I would consider the make or break support. And we'll probably see a retest there of up to that level. Now, this is a chart that I drew, posted actually on my chart list on StockCharts about back at the end of May. And I was actually projecting this very completion based on primarily what the identification parameters were for the pattern. And I'm going to pop up the tool here on the StockCharts platform here in a second. But this just kind of shows you this is something where of even just being aware of the different alignments. There are other patterns. There's bat, there's crab. Not going to get into that right here for our discussion. I just want to kind of focus on what's happening in the diamonds and these specific patterns right now. But they do, I think if you're not aware of it, but they do give you pretty clear, substantial levels of support and resistance that I think can be easily learned, understood why a particular M or W type is what it is. But for these purposes, for the Dow, we're certainly squeezed in that 240, 241 level now as our support. And I would be looking for a larger retest back to 251. That's your real make or break. I think maybe later this summer that could unfold. But that's how I look at it. And just to show really quick, I'm going to pop up. Here is the StockCharts website. And this is a pretty interesting chart that I just drew. This is a weekly chart of Twitter. Now, this is a W formation that I've traced out. And I'm actually, let me just show you really quick how to use it. Is just go in and let me go back to the original chart because that's the place to start here. Go to Twitter. And so then I updated this. Let me update that to show the last 3 years. That gives us enough data. And then how you access that ABCD tool is just simply click annotate. And that's where you've got all the markup features in here. Now, this little rainbow indicator gives you a whole bunch of illustration features. The XABCD tool, that's what we introduced back in January. Simply just click that on and begin to look for the M or W formation. So for Twitter here, that's you mark the most significant highs and lows. There's our midpoint of the W formation. And then I'll go up to here. Now this W type, I'm going to try to line that up with each point, but the key difference in all these M and W formations is your B point. And so I look at this, and this B point much lower than the other examples in the diamonds. And that was more of a Gartley structure. This is more of a bat structure. And the bat pattern has an 88.6% ratio requirement. That's just one of the rules. But really, the general take is that it's a deeper retracement. So I'm looking at Twitter. I would still be looking at this right up there. Look at this still to reach on the weekly level as high as 49. We can utilize the XABCD tool and the patterns to kind of target where the completion zones will be as a minimum, and then take a look at the resistance reaction when we get up there. But just to differentiate those types, if it was a Gartley structure, let's say our B point was up here at a 618, we would be looking much lower, and that would be a 786 right there. But this really shows you kind of how you can fool around with that XABCD tool, look for obvious structures. I'll show one more here. Erin, you mentioned Marvel, and I thought this was pretty interesting. I would look at this very much a short-term trade. Again, not anything of like a long-term forecast or anything, but let me just show this a little bat pattern here where you can go and just kind of click the highs and lows. But I would look at that and then look at that. There's a midpoint. And that's more of a bat pattern structure. Right at the 886, it's a little bit lower than we are right now. But for me, that would be a very nice short-term opportunity to buy maybe a relief rally. Now, there's more to it, but again, just to show you how we utilize the XABCD tool on the stock charts program, and then you can save it to your list actually too, which is something I do, and upload it, and then the analysis will always be there. So that's something to look at. I do want to reference two new contributions that we're providing, and I don't want to get into it too much, but I've spent a great deal of time, and I put together a real history of where all of the harmonic pattern concepts started from, which was mostly wave theory and ratio theory. And even going as far back as books from the 1930s and explaining what they were talking about 100 years ago. We're going to upload that to the Stock Charts library, and it gives you a really clear foundation of, okay, what these M and W structures are all about, and then what the ratios are about. Why are we even considering Fibonacci ratios? And then there's a follow-up article on the situation in the Dow and how we would look at that. So with those charts, it's just to go back here really quick and to show what I'm looking at right now. So after we've worked through a few examples, again, this chart in the Dow, because we're very close to the 618 retracement, sets up this entire framework. And I expect us to continue to be bouncing from support to resistance. I think a lot of people are looking for the major breakdown later in the summer. Well, we'll really know under this 233 level. And if we break under that 233 level on a longer term basis, that would be your key. You would not only be violating the lows, but you'd be violating this very important bat pattern. And yeah, let me show, that bat pattern. So this is, again, getting squeezed in from the perspective of the XABCD harmonic patterns. Certainly your analysis really starts to tighten up here over the summer. And I would look at the 237 level, utilize this pattern here as your support. On the resistance side, again, that 252 level. And of course, we know the Dow has implications for major markets. So that is all this analysis done on stock charts and on the platform with that tool. So again, check that out. I think it's a great new feature. Over the last 6 months or so, several people have reached out to me and want to know more about that. And I lead them to say, go check out harmonictrader.com. And I have a lot of information as well about harmonic pattern stuff and more information about XABCD pattern types. So I'm going to kick it back to you guys if you want to take any questions.
I was going to see first if there were any questions in the room. Do you have any, Erin?
No, not yet. I think everybody was paying very, very close attention.
Yeah, I would be interested, Scott, if you have a minute, maybe to look at the banks, because the banks, I could give you like the Dow Jones US Bank Index, which is the $ DJUSBK. This has gone back and retraced all the way back down to the lows that we saw back in January. And I don't know how that relates in how you look at it with the harmonic trading, but I'd be interested to see, what your thoughts are on the banking group.
And let me go back a couple of years here, and that's on the weekly. Let's go to the daily. A lot of interesting. I'll look at this, and then I know the XLF is a very interesting situation in itself. I would look at a couple things here on leading up to not only where we are currently. Let's go into the annotate mode, and just so we can trace out a few things. Click there. One thing that to note here over the last, and this is showing almost 4 years, 3 years of history, is I would look at this last formation, that last extension. Clearly, we're reacting off of the rally from 2017, but let's just take a look at both of them. And again, just to you actually access that ABCD and then click on the first high, click on the second. The B point, remember, we're just dealing with a W structure. So it's the clearest middle point. Our C point, again, cannot exceed that A point. And then click on the top, the peak there. Now, this formation is actually a crab pattern. The crab pattern, we look at the crab pattern at a 1618. That's one of the primary ratios. So we look at it like that. There you go, 1618. It's a crab pattern again because where the midpoint lines up in this W structure. Now, I just want to keep it simplified like that, but and then the other thing that I'll just to highlight is that your harmonic zone, your harmonic resistance would look something like this, because it's more than just the one measurement. But again, I want to keep it simple here. Let's go red, warning sign. And this fits in with a lot of what we see with actually the initial test of numbers and initial reaction. That's exactly kind of what I was describing with the Dow Diamonds, is that they had reached their initial level, and we typically do see a secondary retest. The secondary retest requires a little bit more. In this case, it violated, went straight through our projected area. And there'll be a few other things. I might look at relative strength with this. But now let's look at the formation that just reversed, because we're within the same context of that. So let me go back and just move that out of the way. And look at this last one again. So we have an X, there's your X, there's your A point, that's your extreme low. There's your B point, C point. Now, where did that terminate? All the way back up here. Now, again, we're only looking mostly at our extensions at a 1618. So that's pretty extreme. And let me go back here and illustrate where that would fill in. So if it was a crab pattern, there's the 1618. A little bit lower. I'll just take off that transparency. So again, that violated, hit the test of there, but again, just a pause, not much of a reaction, and more strength. So I look at that, I look at both of these and say, this larger trend still strong. And I would be looking for maybe something off the top here. What would be the next maybe M consolidation pattern off the top here? I think this is respecting harmonic levels pretty well. Even the fact that this has gone higher, we see the pausing reactions. That alone, that's our initial expectation, but that alone is a good sign. And from how I would look at this, and I like to look for pullbacks that have, say, an M formation within an uptrend. So what are the possible formations here? And it would be something like this. So again, look how close the B point is, almost an exact 618 ratio. That tells me, okay, this is a Gartley. And the Gartley completes at a 786. It's just the rules of the pattern differentiation. That puts us right about there. I can't get it. Let me get that into view. And so that's just under the 450 level, maybe 445. And again, this would be a minimum for me. I would wait to see what happens down here, but right off the top, within the longer term uptrend, not a bad idea to be looking at that pattern completion. Maybe it tests this uptrend, but with that pattern to me signals the continuation area. So if this is going to go from here, that I would be looking at that 450 level, just under there, for this bullish Gartley upside continuation.
Can I have you back up for a second, Scott?
Mm-hmm.
Let's go back to the green pattern that you had at the bottom there on the banks back at the beginning of 2016 when it hit the bottom.
Mm-hmm.
I'm looking at this, does the bank index become a buy once you feel like the ABC is completed and then breaks out, say above like the 310 or 320 level? Are you using this to identify like a target going forward?
Absolutely. You're already getting into, and that's a great insight, a possibility of how to look at it as a framework. There's a handful of patterns, and we're mostly dealing with the M and W structure. And so what you're saying is that, let's say you recognize that this standard 1-to-1 ABCD retracement is not going to work out, or even better, you recognize that this is a crab in the works. And your logic says, well, and it is what we call a harmonic breakout, where if we have the W structure and it's pretty distinct, pretty clear, you look at how strong that was through even the static resistance prior pivot point. Okay. I would absolutely use the pattern framework and say, okay, this pattern, I'll ride and I can play that CD leg with an upside preference up to the 1618. And so that is certainly something that can be done. I think it, again, requires a little more to it than just say, hey, it's a breakout. But from the framework perspective that I really like to emphasize of measuring, those kind of relationships become obvious.
Okay.
All right. We did get a question in the chat room, and it is from Frank. Is this ABC technique a kind of backcasting approach, as some have suggested? So more so looking back in time rather than forecasting?
Absolutely not. Actually, what we're looking at right here in the bank index is, Tom had the question of, okay, if I'm looking for an opportunity, what's the next opportunity in the bank index? This is the exact type of forecasting that we do. These are certainly past examples, but what we're currently facing right now, bank index is trading 456. We have a really nice Gartley structure. This serves, from my perspective, as a minimum target where we're not even there yet. Let's get under 450. Let's get down to this critical 786 level, which is around 445. You almost got there on the first test, but with the numbers and the requirements of what satisfies this pattern, I'm still looking at waiting for this to go about 10 lower. And so from a forecasting frameworks perspective, my opportunity still isn't there. And so I'm looking at forecasting to wait for that pattern completion down at 445 as an example of, kind of the forward analysis that patterns provide.
Okay.
Are you familiar with Wyckoff, Scott?
Sure.
Could some of these patterns set up a little bit like Wyckoff? I'm just looking at this bank index where you say, maybe we go down to 445, because it seems to me like, right now, the question why from a Wyckoфfian perspective would be, are we in a reaccumulation phase, or are we in a distribution phase? And sometimes in these reaccumulation phase, from having Bruce Frazier join us sometimes, we have these spring formations where after we've been going for a little while sideways, we take this one move down that takes out the prior lows and actually becomes a spring back to the upside. And when I look at your 445 forecast here on the bank index, it would take out these prior lows and could set up, and again, I'm not a Wyckoфfian expert, but it seems to me like it could possibly set up a false breakdown and a spring back to the upside. I was just wondering your thoughts if you ever try to mix and match, maybe the harmonic, these patterns along with other technical analysis methods like Wyckoff.
Those are absolutely precursors, structural. A lot of those ideas are structural precursors to harmonic patterns that I studied extensively. So there's, from a lot of the ways that I look at it, I think there's ideas and concepts that I incorporate. Some of even the kind of the simple trend line techniques and trend line violations that Wyckoff talked about are effective in harmonic patterns and in timing, where you can, if you have very clear zones, and even some of his trend line techniques are effective in waiting for that signal after the obvious trend break. And sometimes those can lead to actually your best opportunities, because it's kind of at that point you've already failed the uptrend line. Another of his is the shakeout, and this actually exactly what you're talking about would be a very ideal situation to pull a lot of people out of recent lows, and not only thinking that they're breaking this trend violation yet, it represents a nice shakeout area, and so this could be a situation where you shake people out underneath the trend line and then go. And you can look at it even from a static point of the prior support. And that's what everyone else is looking at. Everyone else is looking at this prior support pivot point at 430, but we've got the pattern that's really more pinpoints that level of saying, no, we need to look at that 445, 440 level. Because right there you go. Mm-hmm. Because this is a consolidation pattern. Think of this as a consolidation cycle. It's a 5-point price structure. And, there's been a lot of individuals that have talked about these going as far back as you go to R.N. Elliott, but even guys in the 60s and 70s, two guys in particular, Arthur Merrill and Edward Levy. Not many people know them, but they were the first two really talking about these 5-point zigzag formation as powerful consolidation structures. And, a lot of my work has been to put measurements and ratios on that to find the best optimize these. And that's what this is really about. So, it is a really a price optimization technique, I find. I will look at other methods. I look at relative strength. I mentioned that with the zones, and that definitely helpful. I don't look too much at doing Elliott wave, 5-wave counts or anything like that, but certainly there's a lot of the wave considerations that are implicit with what we do.
I've got one more question before you go, and that is volume. I noticed, when you do these projections using the harmonic and the ABCD, everything's based on price. Does it matter to you at all what's going on with the volume? I see the volume on your charts. I'm just wondering if you use that.
I have this on volume for the default. We've done some research with volume spikes, and one thing that I've indicator I've created is a harmonic volume spike, where we do an analysis to try to determine, okay, what should be the natural harmonic level of volume, and then what is the extreme harmonic range. And what we've really found is we look for exhaustion, and I look for exhaustion at the completion of a zone. And I think even just looking at the chart, we can identify, looking at, there's your pattern area. And then even going back, this is, what's that, 2017 March. That's a really good isolated situation. The highest level, 55 billion shares there traded at the 1618 level. That's an ideal situation of exhaustion, even if it's a temporary reaction. That's probably the best means of looking at that. And then even look at, that would be actually something to look for on this retest down here under 450 is a real nice spike in volume. You get up to 50 billion shares traded and you hit that zone with something like that, that would be a great confirmation technique. And I actually talked about that in my first book about 20 years ago of looking at basic volume exhaustion. But we've had some ways recently with new programs to really quantify that.
Okay, awesome. Well, it's always a pleasure having you on here to talk about this new tool that we have at StockCharts. It's very fascinating to me. Just obviously it takes time and it takes experience getting to know the different levels, the projections, and so forth that you want to use for each of these patterns. But we appreciate you coming on and helping us learn as we go forward here.
Yes, actually, I have a really quick comment from the chat room. It says, after many years of research, I have found that the harmonic trading patterns have a significant statistical edge over other trading schools. Thank you, Scott. I figured that's a great way to end it.
Thanks, Erin. I appreciate it. Really. Thank you, Tom.
Yeah, it's great having you. We'll have you back soon.
Great.
Awesome. There he goes. Scott Carney. Great presentation. I find all of these patterns, it's kind of overwhelming with technical analysis because there are so many different methods you can use and so many different indicators, but everybody sees things differently. And I know from teaching webinars and live seminars in the past, different people see different things on the charts. And so it's always helpful, I think, to bring in different guests that show different patterns, because what someone might look at and say, I don't see anything, somebody else looks at it and says, oh, look at this trend or look at this pattern. So I think it's always good to at least consider looking at different ways of and methods of following the market. And I think the ABCD method's a pretty interesting one.
Absolutely. Okay, 10 and 10.
Yes.
We closed out the symbol requests just a few minutes ago. And here is our RRG. We had about 25 requests, so there's a pretty good chance you'll see yours. And here are the sectors that we got to. And right now, go ahead and like the symbol requests in the chat room. Currently, the most popular, which will be our second symbol, is IWM. So keep those votes in. And in the meantime, let's go ahead and start with RCM, Tom.
Okay, RCM. Well, I've gone ahead. I've annotated this one. And I see a nice uptrend. If you connect the lows going back to early March coming across here, I think a really nice trend line's been established. And that trend line sits right above the 50-day moving average, which has not been violated here in 2018. So I think the combination of the trend line and the moving average is what you want to watch to the downside. We are at a key short-term resistance area. I'm not sure if we just go right through or not. If we do go through, look for volume to confirm it, because I highlighted the last three big moves and breakouts back in March, and then again in early May, and then again as we entered into June. All three took out prior highs, and all three you can see the volume expanding. I would get a little bit more concerned if we start making breakouts with lighter volume, but so far so good. I think the trend line continues to remain intact. I think RCM looks good.
All right, and the most popular in the chat room right now is definitely IWM by a mile. So IWM is your next one. Of course, the Russell 2000 ETF.
Yeah, the Russell 2000 I actually owned. I did sell it recently. I just thought the dollar had gotten up to that 95 level. I talked about it on the show, so I did sell. But when we came back down, hit the 20-day, I actually got into half of it. And I think if we get back down to this double top breakout, anything down close to the 160 level, I'll fill out the position. I don't know if we'll get back down there, and I'll come back to this one in just a second. I was looking at the dollar earlier today, and you can see the UUP making another breakout above the recent highs. I think the dollar remains very bullish, and if we do get the dollar index to make the breakout, which is the dollar USD, that would be a sign that I might want to go ahead and fill out the rest of my Russell 2000 position rather than waiting for it to move lower. So, and keep in mind too, I'm a shorter term trader. I like the IWM for the balance of 2018, as long as the dollar remains strong, which I think it will. So I do like it, but I am a trader. So just keep that in mind. Now, as far as some of the key levels on the IWM from a price perspective, you can see here we made this breakout above the, was that May 22nd high. came back down, and then made another breakout. And we just tested that area for the first time back on Monday. So coming back down to 164, I think that is initial support. We are at the 20-day. What you'd like to see in the near term, if you're bullish, is holding 164, moving back up above that 20-day and moving back up to challenge resistance at 170. So this is the trading range you want to see. If it does break below this price support, I think it brings a couple of levels into play. Obviously, the 50-day moving average. But I think the biggest level on the chart is probably down around 160 because we had multiple tops in 2018 before we finally made the breakout, went back down, tested that level, it held, and then we moved on to new highs. So I'm going to look at support between 160 and 164 on the IWM.
All right. Next one from the recreational products industry, Thor Industries, THO.
Okay, THO, I really like the move higher. Maybe could have seen a little bit more volume. We are testing, maybe putting in a hammer at gap support. That's something to watch for later today to see if we actually hold that. But if we could hold gap support, and I'm just going to draw the line in here. If we could hold on to this gap support right about there, coming across, and break back out above that prior high. So hold gap support and then take out that level. And you can see that was actually pretty big resistance back here, April, May. Second week of May, we tried it again, couldn't get through. And then we gapped up there again just a week or so ago before falling back. So a move on Thor back above 108, 109, I think would be bullish, especially with increasing volume, and would really start to make this what looks like maybe a bottoming head and shoulder pattern, left shoulder, neckline, head, right side of the neckline. This could be a fill of gap support and at the same time putting in that right shoulder, reverse right shoulder. So a breakout above 108, 109, I think would carry some pretty bullish technical implications here.
All right. Our question, our poll today is about the FANG stocks, which would be most vulnerable in weak summer trading. So I figured since we had a FANG stock requested, let's go ahead and look at Netflix.
Yeah, Netflix has been on fire. This has been a great stock. I love this 20-day test. I bought it. I think that this is one of the strongest stocks, remains one of the strongest stocks in the market. I would keep a fairly tight stop as a short-term trader at the 20-day. But longer term, I mean, I could pull up a weekly chart, and I think you'd see that this has been a stock that's been uptrending for a long time. If the 20-day were to fail, I think probably, you know, if things really started to get weak this summer, I think Netflix would probably find some really good support down around 340, 350. 340 being a pretty good support level. You can see the volume pick up in May as we went through 340. And now you've got the 50-day moving average up at 349. So that is if that's kind of a worst case scenario. Well, I guess anything could be worst case. But in my opinion, because I am bullish, if the market does consolidate further this summer and we see more weakness, for me, a worst case scenario for Netflix might be a trip back to about 340. Otherwise, I expect it to hold its rising 20-day and break to new highs.
All right. This one is a low volume, low price stock, but we have people who actually like to look at those. So I'm going to hand it over to you. Strata Skin Sciences, SSKN.
All right. Well, I didn't know that ticker symbol. So
right, exactly.
probably a lighter volume stock. Yeah, I think there were a couple things here on this chart that I find very interesting. Number one is the volume that came in on the breakout. I am a price volume kind of a trader. So I like to make sure when you get breakouts, you have volume. I think that's pretty clear here. The move that we saw in the middle of May was on very heavy volume. Did print that black candle off of an uptrend. So that tells you probably going to have some issues. We went back to the 20-day, broke out. And when we broke out, when we first broke out, we had a negative divergence. But this is why I've always said you got to be careful about reacting too soon to those types of divergences, because as price keeps going up, so will the PPO. And in this case, the PPO took out that prior high, so that negative divergence was eliminated. We pulled back, and when the PPOs break into a new high, I like to use the rising 20-day moving average as support. We went right down to it, touched it, and then broke back up to the upside. I think we're in a trading range right now, and that trading range is from about $2. Actually, I would even lower it down here to this recent low. I'm going to say about $1.94 up to about 226 or so. That's the current trading range for me on SSKN. Love the volume trends. If we do make another breakout, make sure the volume confirms, because you do have a very, very weak PPO again, very similar to the last one. But when we broke out last time, we had the volume. Make sure if you get the breakout, you get that volume again.
All right. Let's see. Galectin Therapeutics. I think it's getting near some interesting support, but I'm just now about ready to get a PMO sell signal. So personally, I wouldn't be going after this one.
All right. What's the ticker on that one?
GALT.
All right. I've heard the company, but I haven't really followed this one too closely. Yeah, I like that breakout on heavy volume. So again, when you clear what's fairly significant resistance, I think that is from back in January. We went sideways, consolidated for a long time. As we made that breakout, I would be looking for volume confirmation. Volume is very important in the way I look at the market. And there you can see the spike in volume to confirm this move to the upside. Notice when we went down, we didn't hold the 20-day, but we did hold price support. I think we're in a trading range right now from the price support level down at 620 or so up to what is now price resistance at 920. Very volatile stock. So for me, I'd want to try and get it as close to support as possible. But I think that this is the trading range that I would continue to trade. I like the volume trends. It's a smaller company, so clearly there's a little bit more risk, but I do like the stock and the way the technicals shape up.
Okay. Our only financial sector request was Goldman Sachs GS.
Okay, GS. Well, I wasn't a big fan of Goldman Sachs going back a ways, and I'm still not. I just don't think that on a relative basis, even when the financials were doing well, Goldman Sachs on a relative basis was struggling. I'm going to go in and show this on the relative chart. At least that's what I kind of recall. So here was a move up. Here was the investment services industry moving higher. The investment services industry is still kind of hanging near the lows of the past few months. But look at Goldman Sachs on a relative basis. And a better way to look at it, here is your relative chart on Goldman Sachs versus its peers. It looks like a ski slope. Just not a good performer. And again, if you're trying to outperform the market, it's really difficult to do that with a relative underperformer. So I think on Goldman Sachs, for me, it's just a matter of stopping this slide that it's on and stopping the relative slide. So I'm going to annotate the recent highs. And so you've definitely got some overhead trend line resistance here that we're going to have to negotiate. And the most recent top after a rally right here at about 235, 236, you can see where the trend line and price resistance both come in at this level. If Goldman Sachs can get up, break out above that level on some increasing volume, and we start to see this relative strength turn around, I'd be interested. Until then, I think there are way too many other stocks out there that look a lot better. So I'm going to pass on Goldman Sachs.
All righty. Another popular one, and we actually haven't looked at this one in a while for the 10 and 10, is Nvidia.
Yeah, Nvidia I mentioned back at the beginning of the month. I think when I talked about June seasonal statistics, Nvidia is one of the worst performers. And maybe before I even annotate talk about Nvidia and how it has performed seasonally over the last 20 years. Look at June and July. Average returns minus 4.8%, minus 4.9%. That's the average monthly return of each of those months over the last 20 years. So on average, each year of the last 20 years, Nvidia basically takes a 10% drop in June and July. So that was one of the things that we had talked about back in the June seasonality. By the way, July seasonality will be coming up here on Friday of this week. But let's take a look at Nvidia's chart now. And we did get a break to the upside on Nvidia right here at the beginning of June, but it did come with a little bit of warning. I remember talking about this, that June and July tend to be weak for Nvidia. And you can see with that final move to the upside, volume was kind of average, higher price, lower PPO, negative divergence, and we are seeing a lot of weakness now on Nvidia. I think the overhead moving averages and gap resistance between 247 and 250, I think all of that's going to proved to be a really difficult level for Nvidia to get through. I'd look for more selling here on Nvidia, to be honest. I think, especially if we were to move back below that 235 level, I believe we could possibly go back as low as 215. So longer term, I think Nvidia is fine. I just think in the short term, I would really pay attention to the short term price support area right here. And I would say the price support and the gap support, which is just beneath it. So this 239, 240 area is one I'd keep an eye on.
All right, let's look at a gambling stock, Boyd Gaming, BYD.
All right, I know I'm probably going a little longer than usual, so let me speed it up here on these last couple. I don't like the move back below the 20-day moving average. And I think we are coming upon, or maybe we just hit some key support. You can see off the first rally, pulled back, we broke out, volume picked up on the breakout, but we couldn't hold that support level on the way back down. If there's one positive, it's that the volume has been kind of light, but still look at today's action, moving up into the moving averages, testing overhead resistance. Here was your support. Broke down, went up and tested it, and now starting to turn back down again. A break below about 34.75 on a closing basis, I think is short-term bearish for Boyd.
All right, let's look at a software company, Box, symbol Box.
Yeah, I think Box was one that I mentioned in my workshop. I mentioned 10 watch list stocks. I think this was one of them. It is breaking down below some prior or recent support, but I do think it's still got the support from breaking out in February. So that's an area that I would be watching pretty closely down here. The recent tail that we saw back at the end of May was right around this level. So I think we're getting close to a key area of support where I would like to see Box hold. You can see the PPO now has worked its way all the way back down to the center line. A reversing candle, and that was the theme from yesterday I was talking about. If we could get reversing candles at areas that we're looking for as support, I think that would be could set us up for some nice trades. So for Box, I would really watch 24 to 24.5. If you see a tail go down into the 23s, we come back up and hold 24. I think that would be an interesting reward to risk entry.
All right, that completes the 10 and 10. And here are your symbols that we went over. They will be up in the Market Watchers Live chart list after the show. Just go to the blogs tab, click on the Market Watchers Live blog, and you'll see the link right there at the top. We'll be right back with the final market update after this message.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.
All right, let's get our final market update for the day. As you can see, most of the markets took off on the open, but we're pulling back and losing some of those gains. The Dow is still up, currently reading 24,336. The S&P is mostly unchanged right now, just up a point. And we can see the NASDAQ has now hit negative territory after staying positive for most of the day. The mid caps are also starting to see that pullback into negative territory. Russell 2000 never really had that great of an open and has been trading below yesterday's close. Currently, the Russell 2000 is down 11.5 points. TSX, Canadian markets, we saw a nice open, just like with our markets. It is now trading just below yesterday's close at 16,269. Treasury yields are down right now. We could see 2.84% currently is the reading for the Treasury, 10-year Treasury yields. Commodities, however, up. Nice big gap up. Seems to have found the intraday high, not really able to push up above that right now. UUP, big gap up, nice move upward. We're not seeing much of a pullback at all from UUP at this point. USO gap up, also starting to find this area of we're starting to consolidate this move to the upside for USO. I still think energy looks pretty good, and I'll be talking about that shortly. Gold, GLD, is down on the day. Not a surprise when we see the dollar on a nice rise currently. And as far as the VIX, we are seeing a rise right now, and we've got a reading just above 17. So we were down as low as 15 today, but we are starting to see a little bit of a rise, possibly because we are seeing those markets turning back down and around. And with that, I'm going to complete our final market update. And let's get started on our new segment called Trade-Off. And actually, this is one I came up with. Tom's usually the one on top of these things, but I thought of one. Everybody talks about short-term versus intermediate-term trades. So what we thought we would do is we'll present a stock. I'll show it in the intermediate term as a trade, and then Tom will get his take on a short-term trade for that same symbol. So I'm going to go ahead and get started, if that's okay with you, Tom.
Go right ahead.
All right, so I ran my focused PMO scan, meaning I looked just at the S&P 500 and 600. And what was interesting is I ended up with these 3 out of 4 were energy stocks. And so I decided to start off by looking at what energy is doing and whether that's an area I might want to consider at this point. So let's go ahead and look. I was looking at RYE. We talk about how the sector spiders are weighted very heavily to some of the larger cap stocks in there. And with energy, that is definitely true with ExxonMobil and I can't remember the other one at the top there. So anyway, I wanted to look at the equal weight energy, and that way you get a little less, of that consideration that you have to make for the fact that they are larger cap. And one of the things you will notice, and we've studied this for a while with Decision Point, is the equal weights tend to move a little bit faster to the upside. And so if you're looking at a bull market for the energy space, this might be something you would want to consider. And so I looked at it and I thought, yes, this looks like a very interesting area. I'm seeing rising PMO. So I decided to go in and check. And let's look at the first one I have is Anadarko Petroleum Corp, APC. So I looked at it on the daily chart and I liked it. I got the PMO buy signal. I was seeing this ascending triangle. Nice move here as far as that triangle is concerned. We would look for an upside target of about, I think I calculated it to about 80 is what we would be looking for. So but before I get into any kind of an intermediate term trade, I must, in my opinion, look at a weekly chart. And, sometimes the weekly chart is not as favorable. But in this case, I think it's very favorable. Yes, the first thing I noticed when I pulled this up was the fact that we had the PMO is near what we might consider overbought territory. But we have seen it stretch out, especially when we hit that really deep downtrend. And I think we're good for a nice uptrend. So let's see. I didn't actually get this one annotated very quickly. I thought I did. And then I'll give it back to you, Tom. You can tell me what you might do with this. But what I noticed is this very important breakout above some, I think, very important overhead resistance. And I think you could make a case for a double bottom here, and a very large double bottom at that. Remember, we were looking at that 80 level as far as a possible upside target based on that pattern we saw. And I think you could make that target a lot higher. I think you could go to at least 85. Look at this area as well with these tops. There are a lot of great areas. And I think for an intermediate trade, with this breakout, I'd probably set my stop fairly low. I would be looking at that 68, 70 range probably with an intermediate term trade. But my upside potential is so much higher. I think that the trade looks pretty good for the intermediate term. What do you think for the short term?
It's a great looking chart. I think APC, first of all, I like to look at it on my relative chart and see how the relative strength looks. And so you've got APC, which clearly has been rising in a market, breaking out the new highs. And, we've got a market that's been struggling for the past few months. So APC on a relative basis there, I think obviously is going to be pretty strong. But if you look at its group, the Dow Jones US Exploration and Production Index, it's a part of this index. And you can see that here we have continually seen the index moving higher. And it is trying to make a breakout today, trying to get back up, say, through about that 825 level. If we get a close above it, that would be the highest level in about 5 or 6 weeks on the index. APC relative to its peers, you can see just broke out on this move. And by the way, that gap up and move higher came on very, very strong volumes. So I see a lot of accumulation taking place. APC is a great relative performer to the S&P, and the overall industry group is also performing well versus the S&P 500. So we've had plenty of guests here who talk about, looking at relative strength and how you always want to see your all these different lines and relative strength lines moving from left to right higher across your screen. And I think you're getting that here. So APC looks like a great trade to me.
Excellent. So what do you have for me? What you've got a short-term trade?
Yeah, the first one I'm going to pull up is WBC, or excuse me, no, that's not the one I wanted. I'm kidding. WBA is Walgreens Boots Alliance. We talked about GE losing its spot in the Dow. Well, Walgreens is the one that just took over. So Walgreens got a little boost here, broke its downtrend in the recent trading, has pulled back, and so far is holding that rising 20-day moving average, which I find to be a bullish development. Even though the volume was heavy, we did come down, hold it, and now we're trying to bounce off. I'd have a tight leash here because I do think if it truly is bouncing, we should not close back below the 20-day moving average. But we're beginning to see some pretty good strength in the drug retailers here in June. We've seen WBA off of its recent double bottom, relative strength low, starting to show some relative strength. It's also begun to pick up versus the S&P 500, and drug retailers are starting to pick up back up against the S&P. So I'm beginning to see some real strength and some relative strength, and I would just want to make sure that continues. I have a very tight leash on it, but I'm starting to see some short-term strength here in Walgreens and in the group in general. So what are you seeing more from an intermediate term perspective?
All right. Well, I figured I'd pull up the weekly chart, and I think the weekly chart looks really quite nice, to be perfectly honest. So let's go ahead and take a peek at that. All right. So as far as the weekly chart, look at the PMO. It's sitting in that oversold territory. We're getting that PMO buy signal. Last time we got a buy signal on this, it came a little late, admittedly, and we did see everything moving back down. But I like this rounded bottom on the weekly chart. So if I were going to consider this as a trade, and let me just get some support and resistance out there. All right. And I'm going to make this fatter. All right, I don't have my translucent set up there yet, but I'm not there at overhead resistance just yet. But that shorter term breakout, at this point, I'd really want to see it get above that 67.50 level. But this might be the time to enter, when you're seeing a pretty good setup here with the PMO. The daily chart, I'll show you that too. It's not as exciting to me, but let's see. Here we go. And mainly because, the PMO is rising, so that's always a good thing. I'm starting to see a little bit of deceleration on this pullback, but I do like the fact that it is sitting on top of that support level at that May high, like you were mentioning. So losing a little bit as far as the volume's concerned, but I think it certainly could set up as an intermediate term trade.
All right, what's next?
All right, let's see what I have for everybody next. And like I said, I ended up going with all of these energy stocks because I liked the charts. I thought they were good setups. All right, so, and unfortunately, of course, when you have a day like we're having in some of these oil and exploration and energy stocks, we are getting these really big moves to the upside. But this is a great breakout in a space that hasn't quite had the breakout. You've got the PMO buy signal lining up here. I like that. You've got EMAs that are set. Look at this scooter sitting above 99 for months now. So this is already, we know, a pretty good performer. But I wanted to look at the weekly chart. And look at this. That is a breakout above some very important overhead resistance. So, and you've got the rising PMO here. So we have a strong stock. We have it in a space that's breaking out. I think I would look at this as a possible intermediate term trade. Looking at the thumbnail and what's been going on here, I would set my stop probably in that $4 range there, maybe $4.25 if I wanted to be a bit tighter on my intermediate term trade. Because it's a low price stock, I really don't need to get too much out of it on the upside, but I would be looking for at least a move to that $6 level. And if this trade or investment hangs in there and we get that breakout, I think your upside potential is fantastic right now for Denbury Resources. What do you see short term?
Another great chart. The only thing I would say, it's in the same space as Anadarko. So it is in with the exploration production stocks. So I don't need to go back down here and show you all of what's going on with the peers. But you can see the DNR relative to the S&P is doing extremely well. And relative to its peers, it's on fire. The one distinguishing factor here between DNR and APC, DNR is a $2 billion company. APC is a $28 billion company or something like that. I'm not exactly sure. I just know that the difference is one's much bigger in terms of size than the other. The reason I like DNR maybe a little bit better is that PSCE, which is the Invesco Small Cap Energy ETF, is just now starting to turn back to the upside after trending lower for a while. Looked like we had a little bullish wedge going. We've broken that back to the upside. So I actually think that the small cap energy stocks look really good to me, and I think this is one of the better ones. So I like this breakout here on DNR.
Perfect.
All right, next one for you. WWE, World Wrestling. They signed multi-year deals with USA Network and Fox Sports for $468 million. That's more than triple its prior deal. And you can see that the price of the stock has just been absolutely going up exponentially, maybe even parabolically. But the volume has been incredibly strong here. The group that it's in has been performing horrifically, but obviously WWE on a relative basis has been a great performer. So this is kind of an interesting one because it has moved up an awful lot, probably carries a lot of risk because of that. I might wait on a maybe gap support test or a 20-day test. But here's a stock that's doing really well in a space that's not doing very well. I say in the short term, I would watch it, perhaps buy it on a pullback at gap support 20-day moving average. But what's the long term saying, or intermediate term?
All right. Well, I'm going to pull up the weekly chart for us here. All right. I kind of have some problems here just because, as you mentioned, it is a really giant parabolic move. However, it doesn't mean that it can't go up even further. I mean, we have an overbought PMO, but barely. I'm with you. I would want to see a pullback to that, at least that 68 area, 67.50 before I'd be interested in getting in. And if I did get in on an intermediate term to ride this one a little bit higher, I always put in a trailing stop on the parabolic moves. When they finish, they usually finish fast, quickly, and everybody gets out at the same time, and you can be caught holding the bag, as they say. So I think as an intermediate term trade, you can certainly go for this, but I also agree with you that you might want to look for that pullback. So I think that was pretty interesting to see where your short-term trades would be versus the intermediate term picture. But yeah, I would wait for that, that 65, 67.50. Just get that pullback a little bit more. We're up almost 8% on the week on a Wednesday. So I'd really like to see a bit more of a pullback here.
Yeah, I'm a short-term trader and I like momentum, but it's hard to pull the trigger when a stock's been up this much. I mean, literally 5 or 6 weeks ago, the stock was $43, $44. Now it's $72. That's hard to be jumping in and chasing.
Right. And then on an intermediate term basis, I generally would avoid that. So, but if I were to get in, yeah, I'm with you. I'd wait for a little bit of a pullback here and then ride it with a trailing stop.
All right. Well, I hope everybody enjoyed this new segment. Why don't we go ahead and get a summary of a few of the stocks that we talked about. Erin picked two, I picked two, kind of looked at them from different angles. And then, of course, Erin did talk about the RYE, which is that equal weight energy ETF as well. So there's some, some thoughts, some ideas. We concentrate a little bit on the energy side, but that makes sense because energy is really doing well right now.
Exactly. I think it's pretty hot. And like I said, seeing that equal weight breaking out from a consolidation zone, I really like that. And if I were to get in to I wouldn't go with the spider. I would definitely be looking at RYE as a choice, because I think with the breakout, equal weights tend to move fast, accelerate a little bit faster to the upside than the actual spiders. So I think that could be an interesting play.
No doubt about it. I do want to mention tonight at midnight, we have a special running here at StockCharts for membership. I think if you sign up for 12 months, you get 2 months free. So for those of you who are an existing member, you can go ahead and renew or add on membership. You'll get an additional 2 free months for signing up for 12. And there's never going to be a better time to join if you're not a member currently, because you will get those 2 additional months to add on to your membership. So
yeah, absolutely. We don't run those specials that often. So
yeah, they really don't.
Advantage when they're here is a good idea.
Yep, December. I think usually sometime around the end of the year, there's a special, and usually midsummer. So this is the time. The savings are hot, so to speak. But anyhow, yeah, the market right now, we did reverse back down earlier. The Dow, which was up at one point, a couple hundred points, maybe 250 points, has now gone red. It's down 21. The Nasdaq's down 58. I said, earlier in the show, I just didn't feel like this rally didn't feel like it was very strong to me. And there are some positive divergences that could be developing on the software index, the semiconductors, and on internet on 60-minute charts, if you pull those up and take a look at those. So that's something to be thinking about as possible areas where we might get a bounce. But right now, short term, not looking very good to me, Erin.
Yeah. And our poll was, which FANG stock would be most vulnerable in summer trading. It's pretty much split down the middle, except for Amazon, which everybody thinks is going to be just fine. So
what was the highest percentage?
It's a tie for Netflix and Google. Yeah, I thought that was interesting. Apple and then Facebook, but all of them have sort of in that, 24, 25% area. So very interesting. But I have to say, I'm with everybody else. I would not have picked Amazon. Amazon is just killer right now.
I would not have picked Netflix either, to be honest. I think if I was, looking at the list, I think Facebook would have been my choice.
That was my choice.
Oh, there we go. So that means go out and everybody should buy Facebook, because it's probably going to have a strong summer after Erin and I both said it's not.
Exactly.
Anyhow, there you go with the upcoming schedule. Dan Russo is going to be with us tomorrow. And of course, Everything Stock Charts on Friday. And when you fill out that survey, remember, Erin looking for some ideas, maybe some different patterns that you might want her to show. So make sure you include that as well. Hard to believe another show has come to an end, but I do want to thank everybody for joining us today. As I mentioned, please remember to complete that survey as you exit. We'd love to get your feedback. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. We'll see you back here tomorrow. Happy trading.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.